We're jumping straight into Opendoor today. If
Mhm.
you're watching this stock, you know the price action has been just wild. We're talking about periods of gains in the range of 300%. It trades like a rocket ship. But the real story for you isn't the daily volatility, it's the operational pivot happening beneath the surface. This strategy they've dubbed Opendoor 2.0, which, well, it promises adjusted net income profitability by the end of 2026.
Exactly. That turnaround story is absolutely critical right now. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next. All right, let's unpack this operational pivot because the company is telling us this path to profitability isn't just, relying on the housing market miraculously recovering. It's driven by fundamental, painful efficiency and sophisticated AI. But wait, a 41% operational cut while you're trying to scale new technology? That sounds like a business doing surgery on itself. How are they even achieving that without breaking the whole system?
That's where the numbers get really compelling. They've clearly defined the target, adjusted net income profitability by the end of 2026, calculated on a forward 12-month basis.
Okay, a clear target.
And to get there, they had to dramatically reduce overhead. We saw a huge 41% year-over-year reduction in adjusted operating expenses, which brought that figure down to just $53 million in the third quarter of 2025. This cut is the financial foundation, the cost control that lets them survive this market.
So the 31% cut is crucial. I get that. But you can't just cut your way to profitability forever if you can't scale revenue efficiently. Where does the AI play into this? Is this less about smart pricing and more about smart scaling?
It's both, but the scaling aspect is the moat we really need to focus on.
Yeah.
Their proprietary data and these AI-driven processes have allowed them to achieve nationwide ZIP code coverage extremely rapidly.
Right, something that would typically take competitors years of manual work hiring regional teams.
Exactly. And what's fascinating here is how quickly this AI is scaling their volume without inflating those operating expenses we just talked about. Essentially doubled their home acquisition speed. They went from around 120 homes acquired weekly to 230 weekly by late Q3.
Wow, okay, so that's the multiplier effect. The cost cuts give them stability, but doubling acquisition speed proves the new, leaner model actually works at volume.
It shows they can execute transactions faster and more accurately than before.
That speed and reach are undeniable competitive advantages in prop tech. And it sounds like management is betting big on this turnaround. We've seen some moves that tie leadership directly to performance, right?
Absolutely. The new leadership hires, we're talking President Lucas Matheson and CFO Christy Schwartz, they aren't just there to manage the status quo. Their compensation packages are explicitly tied to hitting specific share price hurdles.
So they only win if the strategy works.
It's a powerful signal.
Yeah.
And beyond personnel, they also move to enhance the platform's stickiness, to really monetize everything. Tell us about the strategic moves to integrate services.
The acquisition of homebuyer.com is the best example. That deal is designed to integrate mortgage services directly into the platform. So if you're buying or selling through Opendoor, they now want to capture all that ancillary revenue from financing and closing services.
It's a fundamental change to their revenue model. They're moving beyond simply relying on the gross profit spread from flipping a house.
So they are transitioning from a pure balance sheet risk model, where they hope to buy low, sell high, to becoming a full real estate ecosystem. It's about making money on the flow of transactions, not just the inventory.
Exactly. And this shift is the core of the bull case. But now we have to talk about the financial realities. Because risk is absolutely part of the equation here. You, the investor, need to understand how the balance sheet supports this.
Okay, let's start with the good news on the balance sheet. They need a fortress to execute this turnaround in a turbulent housing market.
And they have one. Liquidity is robust. The company maintains a strong end cash position of $1.452 billion.
Okay, 1.45 billion.
And critically, $962 million of that is unrestricted cash. Their current ratio is also excellent, sitting between 2.8 and 4.4. This cash buffer means they have significant runway.
That kind of liquidity is essential peace of mind. But peace of mind doesn't print profit. Where is the real pressure point coming from right now?
That pressure is right on the top line and the margin story. While they are cash generative, we saw positive operating cash flow of $435 million in Q3, which is a great sign true. GAAP profitability remains challenging.
Yeah, the revenue numbers certainly underscore that. Q3 2025 revenue came in at 915 million. That was softer than the market hoped for, a miss versus consensus, and it reflects a pretty significant 33.55% year-over-year decline. That tells me volume has not returned yet. That's the bear case screaming at us.
And this brings up a crucial distinction: the difference between their adjusted profitability target and the current GAAP reality. Their target is adjusted net income profitability. But in Q3, they reported a GAAP net loss of $90 million.
Why does that distinction matter so much in a turnaround like this?
It matters because adjusted often excludes significant non-cash items, like stock-based compensation or other non-recurring charges. By targeting adjusted net income, management is signaling that they believe the underlying unit economics, the profit per house, is strong. They're asking the market to trust the operational efficiency, not just the current accounting snapshot.
That makes sense. Separating the cost of the actual real estate business from the costs of running a highly compensated tech company. Now let's talk margins, because that's where the historical baggage shows up.
Right, the margin story is complex. Q3 GAAP gross margin was 7.2%, down slightly from the prior year. And the reason for this pressure is absolutely critical. They were selling through what they call legacy inventory.
Legacy inventory, what exactly is that?
Think of it like clearing out a basement full of old stuff you bought during the 2021 frenzy. These were homes acquired under the old strategy, before the cost cuts, before the sophisticated AI took over. And those homes just have worse economics when they sell them today.
So the 7.2% gross margin sounds okay, but if management is blaming that on the old inventory, that implies the margin on the new Opendoor 2.0 houses is already higher.
Precisely. The focus now is on driving the contribution margin. This is the metric you need to watch. It's the raw profit they make on a house after direct costs. When they say they're targeting 5 to 7%, they're talking about this metric for the new inventory.
So until the legacy inventory is fully cycled out, we'll see margin pressure, but the underlying trend on new purchases should be improving. It's the difference between looking in the rearview mirror and looking out the windshield. It's hard to ignore the price swings, though. Forget the operational story for a second. What macro lever is truly driving this stock?
Opendoor isn't just trading on its P&L, it's trading as a high beta vehicle for housing recovery. Its technical beta is high over 3.6. That's nearly quadruple the S&P 500. It's less a housing stock and more a highly leveraged wager on Fed policy.
We saw this play out, right? When news broke about a potential, what was it, $200 billion mortgage bond purchase plan, Opendoor just spiked. Because if rates fall, transaction volume is expected to rocket, and Opendoor benefits disproportionately.
And there's another fascinating policy narrative that could actually be a tailwind. There's been talk about proposed bans on institutional home buying, and a lot of investors immediately see that as a risk to Opendoor.
Wait, won't a ban on institutional buying crush their volume since they are, by definition, an institution buying homes?
That's the critical nuance. Management has clarified that such a policy wouldn't hurt them because they are short-term flippers, not long-term landlords. The policy targets entities that buy homes to hold as rental properties. Opendoor acquires, renovates, and resells. They're liquidity providers.
So by reducing competition from long-term institutional buyers, Opendoor actually faces fewer competitors when they're trying to acquire homes.
Exactly. Management even suggested it could boost their conversion rates. It turns a political risk into a surprising operational advantage.
That's a fascinating twist. Now, let's talk about the pure technicals driving those extreme price swings. The volatility is off the charts.
Yeah, that's driven by the high beta nature and speculative flow. We've seen aggressive call buying, a low put-call ratio. It all indicates highly speculative bullish positioning. Traders are betting big on the turnaround, and this creates serious momentum and massive short squeeze potential.
Especially when the short interest is reported around 13.22%. That's a perfect cocktail for volatility.
But that pendulum swings both ways. That same high short interest means any cool down in momentum can amplify the downside. That remains the main short-term risk.
So what does this all mean for you? If you're following this story, what are the immediate key dates you need to monitor to see if Opendoor 2.0 is sticking the landing?
The most critical near-term catalyst is the Q4 2025 earnings report. We expect that in early February of 2026. Management needs to demonstrate concrete progress toward their promised 35% increase in home acquisitions. And crucially, they have to show us that the new inventory, the post-AI houses, are pushing that contribution margin toward that 5 to 7% target.
And beyond the company's numbers, we have to watch the macro environment. Keep an eye on the Fed minutes and pending home sales data coming out in January. Any signal of easing rates will be a massive tailwind. So if we synthesize all of this, Opendoor is absolutely a high-risk, high-reward turnaround story. The central question is whether the operational efficiencies, that 41% OPEX cut and the AI acceleration, can outpace the housing market headwinds.
Exactly. And the provocative thought to leave you with is this. What happens if the housing market stays sluggish through 2026? Will management need another round of massive cuts, or is the platform finally lean enough that it can turn adjusted profitable on just tepid volume? That's the true test of the 2.0 model.
That's the lowdown on Opendoor for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.